Also going to be on the call, Scott?
She's on the other line. She's just going to listen in.
That's fine. That's great. Okay, well, great. Before we start, I just have to kind of read out some disclaimer. So,
Yeah.
my name is Amir Khan. I'm one of the teachers and mentor in the group where he's also a member of that group. In other words, we use the same investment strategy in real estate. Uh,
Mm-hmm.
and so I know him from there. I don't know him more than beyond. I'm just here to help him out. So
Mm-hmm.
I'm not here to vouch for him or anything like that. I've never done work business with him. Also, it doesn't matter to me whether you invest with him or not. I'm not a partner with him. So having said that, I
Okay.
can answer any questions you may have.
Uh, well, I didn't know how you wanted the meeting to progress, Seth. I've done some research on the program, and I'm pretty comfortable with most things, but there's a couple of things that I'm a little uncomfortable with. The one thing I'm comfortable uncomfortable with is the fact that I know you try to find a really good tenant buyer, somebody that really wants to live in the home and buy the home outright, ultimately refinance it and keep it as their own home. However, I know there's also going to be situations where people just simply say, I don't want to live here anymore, or they simply can't make the payment longer and they're going to walk away and we're going to have to foreclose on them. And since I don't have the property, Seth, you would be the one that actually has to do that foreclosure process.
Well, let me
And in the meantime, we're not, how are we completely comfortable that we're going to continue to get payments when you don't have a renter in there or a buyer anymore? And you've been saddled with a foreclosure process, you've been saddled with a legal process, and you've been saddled with a lack of income now from the tenant. So
that's a
this is
very good.
something that is I'm a little uncomfortable with, considering that I don't see any so far. I don't see any credit checks or verifications of income or anything like that when we're in the private mortgage market.
All right. Well, let me address that. So that's a very good question. So number one, we are not foreclosing. So the way the system works is if you have someone so you are familiar with contract for deeds, right? Or agreement for
Yes.
deed, right? Okay. So
Yes.
the whole idea is the way we write our contracts is that they have equitable interest in the property, which means otherwise it's not legal to do CFDs, right?
Right.
However, one of the terms in the CFD is if they're delinquent, their status changes from their ability to own the property to becoming a tenant, which
Okay.
converts the process to eviction rather than foreclosure. So we don't do foreclosures, we do
Okay.
eviction.
Eviction.
And
Okay.
which is, as you know, is a relatively straightforward process. In fact, I have properties in several states. In Toledo, it takes about 2, 3 weeks, and then you repeat the process. So that
Yeah.
answers your first question.
Yeah. Okay.
Second question is about not having somebody in there and Seth making the payments. Uh,
Yes.
I'm sure Seth's going to operate the same way that we all operate, which is that we make payments regardless of vacancy factors, whether there's an eviction going on or whether there's a turnover. And there are two
Right.
reasons for that. One reason is whenever we repeat the process, so obviously we don't want that. We want somebody who's going to be good, who's going to be steady, who's going to live there, make it their home. By the way, there's more than one type of buyer. One
Yeah. There's
is
three types, right?
correct, correct.
Yeah.
So if it's an investor, then it's the investor who's doing whatever. If he's doing an arbitrage, getting a Section 8 or whatever. There are
Mm-hmm.
tradesmen who buy it. Sometimes other
Mm-hmm.
contractors buy it. So it's a variety. But either way, the idea is we want to get the best match. But if it doesn't work, it's a simple process of eviction. Now, when we do this, we repeat the process, which means whoever comes in does put a small down payment. So that also adds to a little buffer cash. And we are all taught the way I operate as well, and I'm sure that's how Seth is going to operate, is you need to have cash reserves,
Mm-hmm.
which is not just the buffer, but it also helps you make your payments to your private money lender. So
Mm-hmm.
the way we manage our businesses is the payments to our private money lender does not stop, regardless of the vacancy factors and the turnovers.
Okay. Okay. So how are we assured as the investor that the person that is going on the title, in this case, say Seth, how are
Mhm.
we assured that he will be able to make those payments? I mean, I do know him. Obviously, we know he's formerly employed, but I haven't done any kind of, nor do I didn't think about it, background checks or credit checks or financial credit checks or anything like that. So what's the assurance, and is that not needed? Is that not necessary?
No, 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 absolutely. As a private money lender, you need to be assured that number
Yeah,
one, for you, the biggest issue is not just the payments, it's that your principal is assured. Payments are a small thing, right? I mean, yes, obviously it's important, but the most important thing for you is that your principal, if it's 30 grand, that's assured.
right.
And the way our model works is, and if he said does it right, for example, I have properties and I have a lot of private money lenders in my, my portfolio. That's how I run my business. So
Yep,
the way I do it, and I'm hoping Seth will do it the same way. And you as a private money lender, you sound like you're sophisticated, you'll understand this. So when I buy a property and I bring it to my private money lender, on an average, I'm buying 30 grand, right?
yep.
Property has to be worth more than 30 grand. In other words, there's equity built in. In my case, I look for 30%, right? Now,
Yeah,
remember,
I want to go 70% of loan to value. That's right.
sure, yeah, exactly. So now there's another thing with that is obviously there are no guarantees. However, when you work with that idea to begin with, when Seth does bring a property to you, you look for what is that spread in there. What
Right,
that does for you is remember your risk profile diminishes from the day he starts making payments. But if worst case scenario happens and you do have to take the property back, if you just turn around and put the property back, even on the MLS, as is condition without doing repairs, you should be able to get your principal back. In that sense, this system makes it less riskier than a fix and flip. Because if you did a fix and flip, your valuation was based on after repair value. In
after
this
repair
case,
value. Yeah,
these properties are as is what we are buying them at. So as long as he brings a property to you which has that a little bit spread in there, that is something you
yep,
work on. I think that is your biggest security in that sense that okay, my principal is secure. Now on monthly payments, that's something I think it's entirely up to you. There are many ways of doing it. Reserves is one. In this case, he's employed. I think that itself is a big thing. You also know him. I think those are layers that as a professional private money lender, you get better at it. You have an idea of who you can trust. At the end, anybody can fail, so there's no guarantee of anything. But in that sense, you can
right,
minimize your risk by knowing, okay, what's the worst thing that can happen? If I
right,
get the property back, would I at least get my principal back? And
right.
in this case, the way we operate, it does really help you with that security.
Okay. Yeah, because obviously I want to minimize my downside risk, but I know also I'm not getting a 12% return for nothing. So,
Right.
okay. So that being said, um, here's my other situation. My other question is when basically it seems to me that the process would be a two-step process rather than a one-step process. The way Seth has explained it to me is that he identifies a house property, and then it basically title does everything, and his name is on the title, his name is on the insurance, and then basically then I provide title with the money, which because I'm basically the financier, so I'm the bank, and I end up in first position, and of course I told him I have to be on the insurance as well. But it seems to me that for me to have a controlling interest, I would have to actually do another step. I think it seems like I would want to buy the property first, take ownership of it, put it in my name, my title. Then I basically sell it to Seth and or on the time period. I mean, I give him the money, but then I put Seth's name on it because now it's like I'm an investor, so I bought it and now I'm going to basically turn it over.
That's not how the system works. So the way our system works is this: the deed stays in our name, and you
Okay,
are a passive investor. You can do it that way. I'm not saying you cannot. What that does complicate is that for Seth to now go out and do another contract for deed becomes complicated because legally he's not the deed owner. He cannot legally sell the property. Do you see that? You can do that, but he cannot do that.
correct.
So that's why this the what we do won't work in that scenario. Uh,
Okay, so then the process is this. Where's the appraisal? I don't understand where the appraisal is. He's shown me properties. He sent me some comps, but where's the appraisal? Where are the fees for that?
So we usually don't get an appraisal done.
Uh huh.
We rely on comparables, just like an appraisal would do. Appraiser would do. You would look at sold comps,
Right.
and based on that, you come up with a value. You can get an appraisal done. That's not. It's just an additional cost. If that is something you would require, then yes, you can. You can of course ask him to do it. None of my private money lenders ever asked me to do that. I actually do a very thorough underwriting. We do a 26-page report for each of our properties, so it's quite comprehensive. And so usually
Okay.
it's not required. And again, we're talking about 30 grand property. So
Right.
if it was, $200,000 property and there's a difference of 30, $40,000 in appraisal, then it does matter, right? Because that's a
Right.
large amount. But when you're dealing with a $30,000 property and you have enough comps to justify, you're going to be off by a couple of $100 if you do it right.
Okay. So essentially, then, walk me through the process since you've been doing it a while. Walk me through the process as if I was your private money lender.
So again, I'll just tell you my process, and Seth would. I'm assuming he's going to do it this way. So I have a
Yeah.
very streamlined process. So I'm not going to explain my process because it's very different. So I have a investor portal. My investors log into my portal. They see the deal flow and all that. So I'm not going to go through that. But
No, that's
essentially,
fine.
what's going to happen is he will have to get a property under contract first. If he doesn't get a property under contract and he shows you the property and you get all excited and then the property is not is sold, then you have to start over the process again. So there has to be an understanding where if he puts it under contract, he needs to know what his exit strategy is. Because
Okay.
see what happens. Let's say he puts a property under contract and you say, well, I'm not interested in this. I want to pass on this property. He
Uh
needs to
huh.
have an exit strategy. It's not
Right.
that hard. We have over 1,000 people in our community. He can
Right.
wholesale that property to somebody in that. As long as he did the numbers right, he should be able to do that, right? So, Seth,
Right.
do you understand what I'm talking about now? So you could do that.
Correct.
So but you do have to get a property under contract. As soon as it's under contract, the first thing you do is run your numbers. You should be doing it before you actually put it under contract. But by that time, you'll have the numbers, you'll have the comms, you will have the rental comms, whatever Scott needs. He may ask for more things. You need to provide it to him. He will decide yes or no. Once he decides yes, then you're going to provide that information. But Scott, how are you planning on funding these or the first property?
I could either do it through, an LLC, or we can do it through an IRA, a self-directed IRA.
Okay, perfect. If you do it through a I do a lot of work with custodian companies. So self-directed IRA would be a lot beneficial because if the money goes back into your account, there are no tax consequences.
Right.
So the
Right.
only thing is, do you have LLC? Do you have a checkbook control on your
Yes.
IRA? Perfect. So which means there's no delay in terms of funding, right? So I would
Correct.
suggest you do so. So what will happen is he puts it under contract, you commit on it, then he simply informs the title company, this is the lender. He's going to lend through his. Actually, they don't need to know anything more beyond this. They just need to know that there's going to be a mortgage created, as far as
Okay.
the company is concerned. Between you two, you need to have a promissory note. So Seth can have.
See, that's Seth. I've been talking to you about that. I
Yeah.
said, where's the promissory
You
note?
need a promissory note, and that is something you can either have the title company prepare for you, or you can have to hire somebody under attorney from outside. And then Scott, when you receive it, just have your attorney look at it, or you've seen enough, you'll be able to make any changes if you need to. So the best thing would be to send Scott a draft of a mortgage and a promissory note. So
Yeah.
the promissory note, the original stays with Scott. Once you sign it, stays with him. The mortgage, the original with the wet ink, in my experience, has to go back to the title company because the title company will file that showing that there is a first lien position on
Yeah.
the deed of trust. So the original has to be filed with them. So
Right.
be aware because of you're probably in different locations. It has to be mailed to the title company, and they can close before they can close before they receive the physical document, but they cannot file at the county level if they don't have it. So
Mm-hmm.
that's one important thing. Now, you're right about the insurance. Even though he will pay for the insurance, Scott would be listed as the mortgagee.
Mm-hmm. Okay. Okay. So, okay, I just lost my train of thought. Amir, sorry about
Yeah,
that.
no,
Just give
that's
me one
okay. And
second.
so the only other thing after that would be once Seth knows when the closing is going to happen, the funds will from you will go to the title company. It will never go to
Right.
Seth. Once the funding is done, disbursements are done, you'll just get a confirmation that it's done. Then it's between Seth and you to figure out when his payments will start.
Yes.
And it should, my suggestion is to set it up as ACH or automatic payment so you don't have to worry
Yes.
about it. So on the first of the month, be on top of it. So make sure it's coming. Sometimes there's banking error and all that. And as long as that is set up and you're getting your payment, I would recommend to set to monthly give you an update on how the property is doing. Either way, whether it's vacant or it's good idea just to have that communication.
Okay. So, what is the evidence that the property is under contract? Is there an
Uh,
actual contract between Seth and the actual property owner? Is
yes.
there a, that? So I haven't. Okay. So that's the part I haven't seen either. I don't understand that part yet either.
Okay. So
I
so
can send that to you, Scott.
yeah, he can send you the contract so you can
So
have a
you
look.
have you have a property set that we talked about under contract
Correct.
right now at
That
a
was
certain price.
yes, that was the one that I had sent you the comps for. It was the
Okay.
$26,000 and then uh potentially a couple more for small minor repairs.
Okay. So you have that you have that property under contract,
Correct.
and what does that look like? Do you have a piece of paper that shows that a
Yeah.
contractual deed or something?
Yeah, let me send this over to you.
And so
So I
the,
have yet to send the earnest money to title. Um, my LLC was having an issue with the bank account, but it should be up and running by Monday, they said. Worst comes to worst, I'll come out of pocket for the earnest money. It was only 500. Let me pull up the contract for you.
said, are you buying it from a wholesaler?
I am, yes.
Okay. So, Scott, although it shouldn't affect you, but you need to be aware when that's happening. Because what that really means is there's a seller, there's a wholesaler selling to sell. Things
Yep.
do go wrong. When I say go wrong, what that means is, and it has happened to me, and it might just so that you know that, let's say the closing is set up and you wire
Mm-hmm.
the funds, and the seller decides not to sell.
Mm-hmm.
Well, the wholesaler cannot do anything about that, right? The wholesaler will say, well, I mean, I did my best. And so, well, guess what? You have no deal. So now your funds have to be wired back to you. And so be clear on that the funds can only go back to the account they're coming from. Those are small details, but I'm just saying that whenever you're buying from a wholesaler, just be aware that I would be absolutely sure that it's closing
Hmm.
before I would wire the
Well,
funds.
let me ask you a question, Amir. Why wouldn't it be just as simple for Seth and I, based upon a property he's identified, for
Mhm.
me to provide him between he and I provide a promissory note saying he's going to do this, this, and this, secured by this property, and then I simply wire him the money. Now he can use that money for what he wants, but he owes me the money on a payment basis, and he's secured by an asset.
Yes, you
Why do
can.
I have to go through the title company?
You don't have to. Absolutely, you're right.
But
You don't have to.
that's the
It's
part
just
that
for
doesn't
your
make any sense to
security.
me.
It's just for your security that so for example, I deal with a lot of private money lenders who I've never met personally.
Yeah.
They would send the money to me because I have the credibility, but just for transparency purposes and just knowing that we know what we are doing, and most of these people have done this before. So I just tell them, the money doesn't even have to come to me. It goes to the title company, so you know that you're dealing with a because there is fraud out there. So, but if you know him
Okay.
well enough and you feel comfortable with that, yeah, you can do it that way. I don't think there is a problem. I was just thinking in terms of tax purposes, if you send the money to him and then he somehow has to justify his bank account at some point, so that's just a thing to consider. because at that point, then he has to show, well, how did he get the money? He'll have to now show the trail by saying, no, this is one of my investors who gave me the money. I'm just saying that. But if it goes this way, it's
Yeah.
very clear cut that it is for investment, it is for a specific property, and it went to the title company and it was funded from there.
Okay. Okay.
I have the
So,
assignment of contract pulled up. Amir, do you want me to share the screen or should I leave that off?
You guys can talk about that. I don't really need to look at that. I'm just
Okay.
here to, just kind of give you advice.
okay. So
But
there's,
yeah,
so there's a, and I can look at those documents with you, Seth, because that's what I've been wondering about. What kind of paperwork is involved in this? And what kind of promissory note does the title company draw up? I've not seen it. I don't know what it looks like. I don't know how how it's secured by the
Mhm.
property. I mean, is that something that they're doing? Are there fees involved in having them do that? Am I
yeah.
paying those
Here's
fees?
what I would suggest, Seth. Um, you can actually have something drawn by them or your attorney. There are many ways of doing it, and send Scott a draft of that. So it's not the final one, it's a draft, which means the language will stay the same. The only thing that
Yep.
update would be the property address. So
Right.
let Scott then have him look at with his attorney, look at it. Most of them are very generic, they're very boilerplate, there's nothing different. Your mortgage would be very specific. So I would have that done. I think that will really, Scott, really help you. Once you read that, you'll be
Yeah.
fine. I think since you don't read it, it's not in front of you. I can understand it's you're not understanding what's happening, and you want to see it, and it'll help you.
Well, sort of. Yeah. I understand the process, and I do think it's an interesting concept. And the only other thing other thing I need to know is that I know I'm taking some risk, of course. I'm trying to minimize my risk, but how do you how do you identify that the property is basically we're putting the contract property under contract for less than its comparable, less than its market value? So there's built up equity in there immediately.
That's Seth's job to
Oh,
do the comps, look at the sold comps, and you know how the comps work. You will look
yes.
at comparables that are true comparables, which means the specs, the number of bedrooms, square footage, also the subdivision within a half a mile or less, and then come up with an average square footage multiplied by subject property. That will give you what the approximate as is value of the house is. Right now, if the as is value of the, let's say he has a property under contract for 27,000,
Mm-hmm.
as is value of the house is coming at 25. So we have a little problem there. Right now, unfortunately, some people in our community do buy at that because sometimes they're self-funding and all that. But whenever there's an investor involved, just like you're asking for 30% equity, you're looking for property that is probably coming at valuation of 35, 36, something like that.
Right. Right. Exactly.
That would be Seth's
Okay.
job
So
to do
then,
and for you
essentially,
to
then,
verify.
Seth, in this case, you are buying from a wholesaler. So there is a twist now that we know there's a wholesaler, right?
Yeah, I had mentioned that there was a wholesaler on the original call that we had, but
Yeah.
I did not know that part about what Amir was saying, so that's really good to know.
Yeah. It is good to know. Yeah.
Oh, it
So
happened to me twice.
okay. So
And
basically, what happens is the money comes back to you, or not you, but to the investor,
to the
and
investor.
then you have to do start another process, find another house, another property,
That is correct.
right?
And it'll just save
Okay.
you time if you're working with somebody that is reliable, but unfortunately it does happen. So you
Right.
just need to be aware. But
Amir,
that's
the
the
wholesaler
benefit
is
of
part of the group.
it is part he
Okay.
was part of the group.
She
So
is part of the group, correct?
yeah. Okay.
So Seth, when you put the property under contract, um, where are you doing that? You have a real estate, is there a realtor involved in this at all?
So this was an off-market property. So we have
Okay, but
we have
let's
something
just,
called boots on the ground, and
yep,
Jenny Vega. Do you know Cutco Jenny?
I know Jenny.
Tara knows Jenny as well. So Tara's kind of my mentor. She's in this group. Amir knows her. Um, Jenny has a contact out in Peoria, Illinois, who
yeah,
she set me up with. He's a contractor and a handyman,
yep,
and he walks these properties. That's all he does, and he takes extremely detailed photos, extremely detailed videos. I still have all of those. I actually meant to show you those when we were together the other night for your birthday, but the time just wasn't right to pull them up for you. So I can show you.
okay.
I can show you tomorrow or whenever.
Okay, so that's important because I think what we've realized is that we've been doing like a little more piecemeal, and I'm more a process person.
Hmm.
So I'm looking for a process because I'd like to be able to repeat this if it's successful, right? This is just a
Absolutely.
test for the very first one because it's if it's secured 70%, if I've got a 30% equity in it, if I'm looking at a 5-year return, those are good. I'm happy with that. So I feel like that has never been done. I haven't seen a property that's been identified, and here's why we're choosing it, and here's what it, what it looks like. Here's how it's been inspected, and also again, what about you, Amir? What about making improvements to the property before you actually put it on the market?
So, the system we use, and so by the way, let me just very side note, let me just tell you a little background so that you have a reference point. So I've been in real estate for more than 25 years. So I've
Okay,
done residential, I've done fix and flip, I've done new construction, and then I've done commercial real estate. I had apartment complex which I managed, I bought, did a full burst strategy. So I've seen all sorts of real estate investment strategies. And when I
okay,
came across this, I've liquidated all my assets, and then I'm completely now focused on doing this model. And one of the beauty of this model is we are not in the business or of rehabbing properties. And that is the beauty of this is that these homes, you have to buy them as close as possible to being habitable. Uh,
ah,
and the what that means is and set, he's also learning. We're all learning, but the
yeah,
way is you get to a stage where you get a good eye for buying and finding deals that are really good deals for that price, and
yes,
they will rent rather easily to someone who does not mind fixing broken cabinet doors in the kitchen. Maybe the flooring is bad, nothing major. So I never buy properties that have leaking roofs, major foundation issues, missing furnace or water heaters, because these are in the Midwest. They have to have those.
right,
And so as long as no big, repairs that are like the kitchen has to be there, the bathroom has to be there. I've seen homes, they look perfectly fine, and then they go to the bathroom and there is nothing there. So in other
right,
words, you have to do the whole thing. So I do not do any repairs. I bought
okay,
properties. I bought my very first property, had a really big structural problem in only one room, but the entire house was fantastic. And it took a little while, but it so I did not even visit the property. I did not even clean the property. That's how a system works, and that's how we actually save on making and managing and operating this kind of asset. So these are called distressed assets. So you just have to be aware what they are called, and
right,
why it works, because it's a slippery slope. Once you start doing repairs, you're going to do one, then you're going to do two, then you're going to do three, and then you'll realize that you're 30, maybe two, 4, 5, 6 grand in the red for no reason. There was no, because it's not really going to make much difference for a person who's going to make this their home for $800 a month.
okay.
It's not going to get you any better tenant.
So one of the buyers that you were talking about, the three buyers, it is a contractor, right? The kind of guy that would go
Right,
in there knowing that he has the ability to fix things, and he couldn't buy his own home now because he doesn't have the credit or whatever. So he
right.
can buy it on time using this program. So when he makes those repairs, he knows he's only doing it because he intends to actually own that home. Is that correct?
It's possible. There's many things happening. We don't have much time, but very quickly, let me just tell you why these kind of properties exist, so you can
Mm-hmm.
understand the background, and then you'll understand why the system works. The
Okay.
reason why this is happening in certain pockets, and it's happening actually in other states, like even in some states, places in Texas as well.
Mm-hmm.
I'm not going to make this. I'm just going to keep it short. The reason why this is happening is in these markets where we are in, over a period of time, we're talking about 20 years plus, extended period of time, the property values in these certain pockets have been increasing at a very low rate. They're still been increasing, but at a very low rate.
Okay.
For example, let's take St. Louis, Missouri.
Mm-hmm.
Generally, Louis, Missouri was increasing at 8%, 9%, or 10%. There were some pockets that were only increasing in valuation by 1% or 2%. But when you extend that over a period of 20 years, what happens is you have stagnation happening. When stagnation happens, the property value stays pretty much the same over extended period of time. Then something we call them falling below the threshold. That threshold is a lending threshold. So banks say,
Right.
Fargo says we're not going to lend below 70,000. Well,
Right.
suddenly whole pockets are now below that threshold. So major banks are not funding there. So because of that, suddenly a whole bunch of things are happening. People who are actually able to qualify for loans cannot buy in those markets
Right.
because they cannot get them financed. The rehabbers cannot go in there because, well, the valuation has been stagnant. Plus, they don't see the spread there anymore. So then
Gotcha.
these valuations, people are starting to move out from these markets. So everything that you think that you learn in real estate, and like I said, I've been around in real estate for long enough,
Yep.
is valuation, appreciation. You don't even invest if you don't look at those things. This is completely opposite of that.
I see.
But the reason why it's working is people still, because there's a housing shortage. People want to live. They just need
Right.
opportunity to live somewhere, right? So
Right.
we are actually doing good for the community and for the city because if we bring somebody in who's going to make a home that was old, running and going to be run down and boarded up and at some point bulldozed, well, we're doing good for the community, for the people. They're getting an opportunity to buy a home, make their home. Number two, we're doing good for the city. Now they have somebody paying taxes on this, right?
Right.
So that's what we're doing. That's the kind of inventory we are dealing with, and that's why this system works. So if you start repairing them and all that, then you're going in a different direction. So that's
I
why
see.
you don't want to do that.
Okay. All right. Okay. Well, I think I have a pretty good understanding then now. I know you're short on time, so I appreciate it.
Sure. And yeah, and Seth, just the two things that I think Scott will really, really get comfortable with would be send him a draft, promissory note, send him a draft of the mortgage, let him look at it before you
Yes.
finalize it. Because once you
Yes.
finalize it, you do need to get it notarized on your side. Both parties have to have it notarized.
Perfect. I can do that.
Oh, okay.
Thank you, Amir.
Okay. Good. Very
All right.
good.
All right,
All
guys,
right.
good luck.
Thank
Thank
you
you.
very much.
All
Appreciate
right.
your time. Thank
All
you.
right. Welcome. Bye-bye.
Scott, I'll give you a call.